If you've ever heard anything about investing, you may have heard people talk about index funds, and you may have heard them say that they're the best way to invest in the stock market. But what are they, and what makes them so good? Well, in this video, we'll explain exactly what index funds are and why many professionals such as Warren Buffett see them as the absolute gold standard for investing in the stock market in the modern day. Hi everyone, welcome back to the channel. My name's George and I've been using index funds to invest in the stock market for a good few years now. So, what are index funds? Well, they're a type of investment fund, and an investment fund is basically a collection of different things that you can buy which will hopefully go up in value over time, i.e. they're investments. But index funds are primarily used for investing in the stock market, so they'll contain stocks and shares in different companies. Okay, so to really go back to basics for a second, let's just think about what stocks and shares actually are. Well, a company's stock, or a share in a company, is essentially a small piece of that company. And if you buy one, then you essentially then own a small piece of that company, or more specifically, you're entitled to a small piece of their profits, both now and into the future. So the hope is that over time, that company will become more profitable. So you, as the investor, will be entitled to more profits. And so the price of the share will go up in order to reflect this. So you as the investor have made money, as what you've bought is now worth more. But if you only own shares in one company, then you're at a big risk. For example, if you only own Apple shares, for example, something could happen to Apple, which completely tanks its share price. For example, if iPhones start blowing up left, right and centre, you're going to be completely exposed to the resulting drop in share price, whereas other companies in the stock market might be completely unaffected. So this is why owning lots of different shares in lots of different companies is often a really good idea, because if any one company has a bad year or even goes bankrupt, then hopefully that will be offset by the gains in all of the other companies combined. So overall, your entire portfolio is up. Now, if you've ever heard of diversification, this is exactly what this is, as in a diverse portfolio will contain lots of different stocks and shares from lots of different companies, as this is diversified across a range of different companies and industries, and you've spread your risk. So it's a good idea to own lots of different shares in lots of different companies, but how are you supposed to manually select which companies to invest in? And isn't it going to be such a faff to go to each individual one and buy shares in each individual company? Well, this is where investment funds come in, as essentially what an investment fund will do is they'll select the companies to invest in, go and purchase the shares from the company and collect them all into one place. And what you as the investor can do is you can buy a share in the investment fund, which automatically contains lots of different stocks and shares in lots of different companies. As in, it's automatically diversified and you haven't got to manually do anything. So who decides which companies go into the basket? Well, some funds will literally hire an investment manager and a team of analysts whose whole job is to decide which companies are best to invest in and which are the best ones to go into the basket and which ones should be taken out. But this is expensive, as these people need to be paid, and many of the top analysts will demand really high salaries and ridiculous bonuses as well. And if you decide to invest in one of these funds, you'll be paying these people's wages through the fee that you pay to invest in the fund. Now, these funds are known as actively managed investment funds, as their contents are actively managed. You know, you've got a team of people actively deciding what goes in and out of the fund. But over the years, there's been lots of scientific research papers which have been written about these actively managed funds, and many of them find that they're actually not worth the money. And what they mean by this is if you don't bother to hire this team of analysts and simply just take a list of companies, say the largest companies in America, and put these into a basket, then this new basket will oftentimes outperform the actively managed fund, as in the returns it generates over the long term will be as good, if not better, than the actively managed funds. So the money we've spent on these analysts to decide what companies to put in and out of the fund has actually been a bit of a waste of money, as the market in general has performed as well, if not better. So simply by taking a list of companies and putting them into an investment fund is exactly what an index fund is. Think index just means list. So many index funds will just be the top companies in a given country, for example. And there are many different types of index funds. For example, the most well-known are probably ones that are based on the S&P 500. And the S&P 500 is just a list of the largest 500 companies in America. You know, the likes of Apple, Microsoft, Tesla, etc. But there are also index funds from all around the world. For example, you could take the top 100 companies in the UK, also known as the FTSE index, or you could just take the largest companies in the world as a whole, often called a global index. But what really makes index funds so special is, as well as being as good, if not better than actively managed funds, they're actually really cheap to invest in, as you haven't got to bother hiring a team of analysts or an egomaniac investment manager who demands a salary of $5 million a year. All you need is a computer system which can take a list of companies and manually buy them from the different companies and periodically update it as companies come on and off of this list over time. And the savings that these index funds can make are passed on to the investor through a much lower annual fee. Now, keeping the fees on your investments as low as possible is really, really important. Probably a lot more important than you first think. I've actually made a whole video where we discuss this topic in the detail, so have a look if you're interested. But essentially, if you've got a low fee on your investment, then the savings that you can make stays invested, and over the long run, this can result in a really big difference in total investment returns. So it is really important, and it's one of the things that makes index funds so special. So if you're convinced that index funds are the way to go, we'll now discuss how you can actually invest in them. Now, by far the easiest way to invest in index funds in the modern day is through an online platform. Now, there are loads of platforms to choose from. Some of the older and more established names you might have heard of, for example, Vanguard, Hargreaves Lansdown or AJ Bell. But nowadays there are also app-based, more techie platforms, for example, Trading 212 and Invest Engine. And if you're in the UK, you'll be able to open a stocks and shares ISA with these providers, which means that any gains that you have on your investments or any dividends that are paid are completely tax-free. But in my opinion, the best platforms to go for are the app-based platforms, as these have got no account fees associated with them. Now, once you've got an account with one of these platforms, you can now invest in index funds, and different platforms will have different funds to choose from. And there are all manner of choices. There'll be American funds, European funds, global funds, etc. And if you're a beginner, choosing which funds to invest in can be a bit overwhelming. But a good rule of thumb is that for most people, funds which are based on the S&P 500 index, that's the largest companies in America, or a global index which just contains the largest companies from around the world, are often your best bet, as they offer the promise of good returns while also being very diversified. Now, this isn't financial advice, it's just a good rule of thumb, and a rule of thumb that I use personally, so be sure to do your own research. But personally, when selecting the funds to go for, I try and minimise the fees associated as much as possible. As an example, Invest Engine offer this fund called SPDR S&P 500, which is an index fund based on the S&P 500, which is the largest 500 companies in America. And you can invest in this from as little as 0.03% per year. And if you're after a global index fund, then Invest Engine offer a fund called L&G Global Equity, which you can invest in from just 0.1% per year. Now, to plug yet another video, I've also made one which talks about the best index funds on the market in 2025. So if you'd be interested in that, go and take a look. And if you've got any questions about anything discussed in this video, please leave me a comment below. I'll be sure to get to them all. And if you've made it this far, you might want to consider subscribing to the channel, as you're probably a lot like me. I want to learn more about investing and personal finance. And if so, we've got loads more videos on the topic available on the channel, and many more in the works to come. Thanks for watching.